In this video, we'll reveal 6 beaten-down stocks that legendary investor Michael Burry is betting millions on while much of Wall Street remains focused on the artificial intelligence frenzy. More importantly, you'll discover why one of the most successful contrarian investors of our generation believes these overlooked businesses could offer some of the most compelling risk-reward opportunities in today's market. These are dominant businesses serving hundreds of millions of customers, generating billions in revenue, controlling critical parts of their industries, and possessing advantages that competitors struggle to replicate. Yet despite their scale and relevance, their share prices have been punished, ignored, or simply abandoned by investors. And that is exactly where Michael Burry believes opportunity can emerge. Michael Burry became famous for predicting the housing market collapse years before the financial crisis. Since then, investors have watched his moves closely because he tends to look where others refuse to look. Instead of chasing the hottest trend, Burry has been reallocating capital into companies that have fallen out of favor, businesses that continue producing cash, expanding operations, and strengthening their competitive positions. And the first company on his list may be one of the most controversial investments in the entire market today. We're talking about Alibaba Group Holding Limited, ticker symbol BABA. For many investors, Alibaba has become synonymous with uncertainty. Years of regulatory pressure, geopolitical tensions, trade disputes, concerns about Chinese economic growth, and broader fears surrounding international investing have all weighed heavily on sentiment. As a result, a company once viewed as one of the world's greatest growth stories saw its valuation compressed dramatically. But Michael Burry sees the situation very differently. In early April, Burry revealed that he had purchased shares of Alibaba as a new position representing more than 6% of his disclosed portfolio allocation. He specifically noted that the recent weakness in the stock had created what he viewed as an attractive entry point. That statement alone is worth paying attention to. Remember, Burry is not known for making emotional decisions. He is not chasing momentum. He is not buying stocks because they are popular. He looks for situations where market participants have become excessively pessimistic, creating a disconnect between price and intrinsic value. Alibaba appears to fit that framework almost perfectly. To understand why, we first need to understand what Alibaba actually is. Many investors simplify Alibaba as merely an online shopping platform. That description barely scratches the surface. Alibaba operates one of the largest digital commerce ecosystems on the planet. Its platforms connect merchants and consumers across retail, wholesale, logistics, payments, cloud computing, digital media, local services, and international commerce. The company touches an enormous portion of everyday economic activity. Its e-commerce infrastructure serves hundreds of millions of active consumers and millions of merchants. Its logistics network helps move products across vast geographic regions. Its cloud computing division supports businesses and organizations with critical digital infrastructure. Its international operations continue expanding beyond its domestic market. When you step back and examine the scale of the enterprise, it becomes clear that Alibaba is not simply a website. It is an ecosystem deeply embedded into commerce and business activity. That ecosystem creates one of the company's most powerful competitive advantages: network effects. The more merchants participate, the more attractive the platform becomes for consumers. The more consumers join, the more valuable the marketplace becomes for merchants. This self-reinforcing cycle creates barriers that are difficult for competitors to overcome. Building an e-commerce platform is relatively easy. Building an ecosystem involving hundreds of millions of users, sophisticated logistics networks, merchant relationships, payment systems, and cloud infrastructure is extraordinarily difficult. This competitive moat has taken decades to develop. And yet, despite these advantages, investor sentiment toward Alibaba remains remarkably weak. That is exactly why value investors become interested. Michael Burry has repeatedly demonstrated throughout his career that he prefers situations where market expectations are extremely low. In these circumstances, investors often focus overwhelmingly on risks while underestimating the strength and durability of the underlying business. The market's concerns regarding Alibaba are certainly real. Regulatory intervention created uncertainty. Economic slowdowns affected consumer spending. International tensions increased investor caution. Questions about future growth rates emerged. All of these issues contributed to a significant decline in valuation multiples. But valuation is where the story becomes especially interesting. Burry's investment philosophy centers on asymmetric opportunities. In simple terms, he seeks situations where potential upside significantly exceeds potential downside. Alibaba appears to offer precisely that setup. Despite all the negative headlines, the company continues generating enormous amounts of cash flow. The business remains profitable. It maintains substantial resources to invest in growth initiatives, innovation, shareholder returns, and strategic opportunities. When investors become fixated on short-term fears, they sometimes lose sight of long-term economics. Imagine evaluating a shopping mall based solely on temporary weather conditions rather than its location, tenant quality, and cash generation potential. That is often what happens in public markets. Prices move rapidly based on sentiment. Business fundamentals usually evolve much more slowly. Burry believes Alibaba represents one of the most compressed mega-cap value opportunities available today because the market has become excessively focused on uncertainties while overlooking the company's financial strength. Another reason Alibaba deserves attention is its cloud computing business. Cloud infrastructure remains one of the most important technological foundations in the modern economy. Businesses increasingly rely on digital services, data storage, computing power, and software applications to operate efficiently. Alibaba's cloud segment gives the company exposure to long-term digital transformation trends that extend far beyond online shopping. While cloud growth has experienced periods of fluctuation, the broader opportunity remains substantial. Digital infrastructure demand continues expanding globally as businesses modernize operations and adopt increasingly sophisticated technologies. This creates an additional growth engine beyond the core commerce business. Investors often focus exclusively on Alibaba's retail operations and overlook the value embedded within its broader portfolio of assets. That hidden value is precisely the type of opportunity that attracts deep value investors. Then there is capital allocation. One of the most important yet frequently overlooked drivers of shareholder returns is how management deploys capital. Companies generating strong cash flow can reinvest in growth initiatives, improve operations, repurchase shares, reduce debt, pursue acquisitions, or return capital directly to shareholders. Alibaba's significant cash generation provides management with flexibility that many competitors simply do not possess. This flexibility becomes particularly valuable during periods of market uncertainty because financially strong companies can continue investing while weaker competitors pull back. Historically, some of the best long-term investments emerged when quality businesses experienced temporary sentiment-driven declines. That does not mean every beaten-down stock automatically becomes a winner. Far from it. Many companies decline because their fundamentals deteriorate permanently. The critical distinction is whether the underlying business remains strong despite temporary market pessimism. That is the question Michael Burry appears to have answered affirmatively regarding Alibaba. He is effectively betting that the market has become too pessimistic. He believes investors are underestimating the company's ability to continue generating cash, maintaining competitive advantages, and creating long-term value. And if he is right, the potential upside could be substantial. Consider the psychology driving current market conditions. Investors naturally gravitate toward exciting narratives. Artificial intelligence dominates headlines. New technologies attract attention. Fast-growing sectors generate enthusiasm. Meanwhile, mature businesses facing uncertainty often become neglected. But investment success frequently comes from identifying opportunities where expectations are already extremely low. When expectations are low, companies do not need perfection to generate strong returns. They simply need results that are better than feared. That dynamic makes Alibaba particularly intriguing. The company does not need to become the fastest-growing enterprise in the world. It does not need to dominate every industry. It simply needs to continue executing effectively while demonstrating resilience across its core businesses. Given its scale, market position, infrastructure, customer base, and cash flow generation, that outcome appears entirely plausible. Another factor supporting the long-term investment case is the growing importance of digital commerce throughout the global economy. Consumers increasingly expect convenience, speed, selection, and integrated digital experiences. Businesses increasingly depend on online channels to reach customers. These structural trends continue creating opportunities for companies with established digital ecosystems. Alibaba remains one of the largest beneficiaries of those trends. Its platforms facilitate enormous transaction volumes, support merchants of all sizes, and connect businesses with consumers across multiple categories. That level of integration creates durability. Even during periods of economic uncertainty, companies embedded within essential commercial activity often retain significant long-term value. For investors seeking potential mispriced opportunities, Alibaba represents a fascinating case study. The market sees uncertainty. Michael Burry sees opportunity. The market focuses on recent weakness. Burry focuses on long-term value. The market worries about headlines. Burry analyzes cash flows, assets, competitive positioning, and valuation. That does not guarantee success. No investment is guaranteed, but understanding why sophisticated investors make certain decisions can provide valuable insight into how opportunity often emerges in public markets. And in Alibaba's case, Michael Burry appears convinced that fear has pushed the stock price significantly below what the business is actually worth. Whether history ultimately proves him correct remains to be seen. But one thing is clear. When one of the world's most famous contrarian investors allocates millions of dollars toward a stock that much of Wall Street has written off, it deserves serious attention. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The next company is MercadoLibre Incorporated, ticker symbol MELI. If you are unfamiliar with MercadoLibre, it is often described as the Amazon of Latin America. But that description does not fully capture what the company actually represents. MercadoLibre is not just an e-commerce platform. It is an integrated digital commerce and financial ecosystem operating across some of the fastest evolving consumer markets in the world. Its marketplace connects millions of buyers and sellers across countries where traditional retail infrastructure is often fragmented or underdeveloped. That alone creates a powerful structural tailwind. But what makes MercadoLibre especially compelling is that it did not stop at commerce. It expanded into payments, logistics, credit, and digital financial services. In many ways, it has built the digital backbone of commerce in Latin America. This creates a compounding ecosystem effect. When users buy products on the platform, they often use Mercado Pago for payments. When sellers grow, they rely on MercadoLibre's logistics network to fulfill orders. When consumers need credit, they use the company's lending services. Each layer reinforces the others. That is the foundation of a true platform business. Now, despite this strength, MercadoLibre has faced pressure. Investors have been concerned about macroeconomic volatility across Latin America. Currency fluctuations have impacted reported results. Inflation cycles have created uncertainty, and global investors often discount emerging market exposure more heavily during risk-off environments. As a result, the stock has pulled back from its prior highs, particularly around the mid-$1,500 range where Burry reportedly increased his position. But here is where the contrarian view begins to form. Short-term macro noise does not necessarily destroy long-term structural advantage. If anything, it can obscure it. The underlying question is not whether Latin America experiences volatility. That is already priced in through investor skepticism. The real question is whether MercadoLibre continues to expand its dominance across digital commerce and financial services in the region. And on that front, the company continues to show strong competitive positioning. Its logistics network has been a critical differentiator. In regions where delivery infrastructure is inconsistent, control over logistics becomes a major moat. MercadoLibre has invested heavily in warehouses, fulfillment centers, and transportation systems to improve speed and reliability. That investment is not easily replicated. Competitors would need years of capital deployment and operational execution to match it. At the same time, the company's financial ecosystem creates additional durability. Mercado Pago is not just a payment processor. It is becoming a central part of digital transactions across the region. Once users adopt a financial platform for payments, switching costs increase significantly. That friction helps retain users and deepen engagement. This is how ecosystems evolve from optional platforms into essential infrastructure. From a valuation standpoint, the pullback in sentiment has created a more interesting entry point for long-term investors willing to look beyond near-term volatility. And this is where Burry's philosophy becomes important again. He is not trying to predict the next quarter. He is attempting to identify situations where market pessimism has overshot the reality of the business. MercadoLibre fits that framework because the core business has not collapsed. It is still expanding. It is still integrating services. It is still capturing a growing share of digital commerce in its region. The stock may have corrected, but the underlying platform continues to strengthen. That divergence between price and business trajectory is what value investors look for. Now we move to the next name, PayPal Holdings Incorporated, ticker symbol PYPL. PayPal is one of the most recognizable fintech companies in the world. It helped define digital payments for an entire generation of internet commerce. But in recent years, the market narrative around PayPal has shifted dramatically. Once considered a dominant growth stock, it became viewed as a company struggling to maintain relevance in a rapidly evolving fintech landscape. Competition increased, user growth slowed, investor enthusiasm declined, and as sentiment deteriorated, the stock price followed. But beneath that surface narrative, the core business has not disappeared. PayPal still processes massive transaction volumes across global digital payments. It still connects consumers and merchants across millions of daily transactions. And it still operates within a structurally growing industry as cashless payments continue expanding worldwide. What changed is not necessarily the existence of the business, but investor expectations about its growth trajectory. And when expectations reset lower, valuation compression often follows. That is where contrarian investors begin to pay attention. Burry views PayPal through a different lens, not as a high-growth momentum stock, but as a high-cash flow business that has been abandoned by momentum traders. This is what he referred to as a whale fall-type opportunity, a large dominant organism that has lost its momentum but still contains substantial embedded value. PayPal still generates significant revenue and maintains strong operating margins relative to many competitors. It also continues to adapt its platform, refining user experience, integrating new services, and optimizing its ecosystem. One important aspect that often gets overlooked is that PayPal is not just a payment processor. It is a financial network. It connects consumers, merchants, and platforms in a way that creates embedded transactional utility. Once users are integrated into that system, they often remain within it for convenience and familiarity. That retention effect is a form of moat, even if it is less visible than physical infrastructure or regulatory barriers. Another factor worth considering is the company's dividend yield, which currently sits around 1.28%. While not the primary reason investors buy PayPal, it signals that the company is generating sufficient cash flow to return capital to shareholders while continuing to invest in its platform. From a valuation perspective, PayPal has gone through a significant reset compared to its previous market peak. The question for investors is whether that reset represents permanent structural decline or temporary overcorrection. Burry appears to believe it is the latter. He is essentially betting that the market has become too pessimistic about PayPal's long-term positioning in digital payments. Now, before we continue to the next company, it is important to zoom out. Both MercadoLibre and PayPal reflect a similar theme, not explosive hype-driven growth, but durable financial infrastructure businesses that have been re-rated downward due to shifting sentiment cycles. That is often where long-term opportunity emerges. But there is more to Burry's positioning shift than just isolated stock selection. It is also about what he believes is happening at the macro level. He has expressed concern that a large portion of venture capital and investor attention is concentrated heavily in artificial intelligence-related investments, creating what he views as an asset bubble dynamic. Whether that view proves correct or not, it clearly informs his decision to rotate into more traditional cash-generating businesses that are less exposed to speculative momentum cycles. This is not just about picking stocks. It is about positioning against a broader market narrative. Now, as we transition into the next section, we will see how this approach extends into software, consumer brands, and defensive healthcare names that each represent a different angle of the same contrarian philosophy. Before we continue, here is an important message. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now we move into the final stretch of this strategy, where Burry extends his positioning into software, consumer brands, and defensive healthcare. Each one represents a different type of business, but all of them share one critical characteristic. They have been heavily discounted by the market despite maintaining strong long-term fundamentals. We start with Adobe Incorporated, ticker symbol ADBE. Adobe is one of the most important software companies in the world. Its tools are deeply embedded into creative industries, digital marketing, document management, and enterprise workflows. From content creation to enterprise publishing, Adobe's ecosystem is a foundational layer of the digital economy. Its products are not optional for millions of professionals. They are essential infrastructure. That is the first key point investors sometimes forget. Adobe is not just selling software, it is selling workflows that entire industries rely on. Over time, Adobe has transitioned into a subscription-based model, creating recurring revenue streams that provide stability and predictability. This type of business structure is typically highly valued by the market, but recently, sentiment shifted sharply. Investors began worrying that artificial intelligence tools could disrupt creative software demand and reduce the need for traditional design platforms. The narrative became simple and emotionally charged. AI will replace creative software, and when narratives become that powerful, valuations often move before fundamentals do. Adobe experienced a significant sell-off as capital rotated away from software names and into perceived AI winners. But Michael Burry is taking the opposite position. He is betting that the market is overestimating disruption risk and underestimating Adobe's ability to integrate AI into its own ecosystem. In other words, instead of being replaced by AI, Adobe may become one of the platforms that uses AI to enhance productivity and expand usage. This distinction matters. Disruption does not always mean destruction. Sometimes it means evolution, and Adobe's scale, customer base, and integration into professional workflows give it multiple paths to adapt. The company's recent strong quarterly performance further supports this view, showing that demand for its tools remains resilient despite investor concerns. From a valuation perspective, the stock has been re-rated lower due to fear rather than actual business collapse. That is exactly the type of disconnect value investors look for. The next company added to Michael Burry's portfolio is Lululemon Athletica Incorporated, ticker symbol LULU. Lululemon is not just a clothing company, it is a premium lifestyle brand that has built one of the strongest consumer identities in modern retail. Its products are associated with performance, wellness, and aspirational living. That brand power is its moat. Unlike commodity apparel companies that compete on price, Lululemon competes on perception, loyalty, and identity. Customers are not just buying clothing, they are buying into a lifestyle ecosystem. For years, this model delivered exceptional growth and margin expansion, but recently the stock has come under pressure. Competition in athletic wear has intensified, North American demand has softened, and investor expectations have reset sharply from peak growth assumptions. As a result, the valuation compressed significantly, yet beneath that volatility, the brand remains intact. Consumers still recognize Lululemon as a premium name in athletic apparel. Store expansion continues globally. International growth opportunities remain significant, and the company continues generating strong revenue relative to its industry peers. Burry appears to see a disconnect between short-term sentiment and long-term brand value. One particularly notable data point often cited in discussions around Lululemon is valuation relative to sales, which has compressed significantly compared to prior years. At roughly 1.3 times sales, the market is pricing in much lower growth expectations than before. Additionally, technical indicators have shown deeply oversold conditions, which often coincide with periods of investor exhaustion. These conditions do not guarantee a rebound, but they often signal that pessimism may be overextended. Now we move to Zoetis Incorporated, ticker symbol ZTS. Zoetis operates in a completely different world compared to the previous companies. It is the global leader in animal health. The company develops medicines, vaccines, and diagnostic products for pets and livestock. At first glance, this may seem less exciting than high-growth technology or consumer brands, but that is precisely why investors often overlook it. Zoetis benefits from a highly defensive business model. Demand for animal health care is relatively stable across economic cycles. Pet ownership continues to grow globally, and livestock health remains essential to the food supply chain. These are not speculative trends. They are structural realities. Burry has described Zoetis as a fat pitch opportunity, emphasizing patience rather than excitement. This is important. Not every investment needs explosive growth to generate strong returns. Some investments perform well simply by compounding steadily over time in a stable industry. Zoetis fits that profile. It operates outside the volatility of technology cycles, meaning it is less exposed to rapid sentiment shifts driven by AI narratives or speculative trading behavior. Instead, it benefits from consistent demand and recurring product usage across veterinary and agricultural markets. One additional factor that makes Zoetis interesting is its historical seasonal strength. The stock has shown a tendency to perform well during certain periods of the year, particularly in early summer months, reflecting recurring patterns in market behavior and investor positioning. While seasonal trends are never guarantees, they can add another layer of context when evaluating timing and sentiment. When you combine all of these companies together, a clearer picture emerges. Alibaba represents mispriced global digital commerce, MercadoLibre represents emerging market digital infrastructure, PayPal represents abandoned fintech cash flow, Adobe represents misunderstood software resilience, Lululemon represents compressed consumer brand value, Zoetis represents overlooked defensive compounding. 6 different businesses, 6 different industries, but one shared theme. They have all been punished by market sentiment while still maintaining strong underlying economic engines. And that is the essence of Michael Burry's current positioning. He is not chasing momentum, he is stepping into areas of neglect. He is betting that fear has outweighed fundamentals, and he is positioning for a potential shift in how capital flows once market narratives change. Whether that thesis plays out depends on how the next phase of the market unfolds. If AI enthusiasm continues to dominate capital allocation, these stocks may remain under pressure for longer than expected. But if sentiment rotates back toward fundamentals, cash flow, and valuation discipline, these names could re-rate significantly. That is the core tension at the center of this entire strategy. Now here is the key question for you. If you had to choose one long-term winner from these 6 businesses, which would it be and why? If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.